If you could go back to when you were
Mhm.
just starting out in multifamily,
Okay.
what advice would you give to yourself?
That's a great question. I think it's probably things that would come to no surprise when you hear it, but just want to hear it again, right? And,
Mhm.
I think the number one thing is market research. You got to
Yep.
understand the market dynamics. That's not just what's going on, but understand the supply, the demand, understand the rent growth.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
All right, here we go. Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. I'm very excited for today's show. We've got an amazing, experienced investor on the line with us today. And, we'll just launch right into it. So, introducing to you guys, Sapan Talati with JT Capital. So, Sapan, how's it going today?
Doing well. Thanks for having me here, Brian.
Awesome. Yeah, thanks for coming on. So, where are you calling from today?
Southern California, Orange County.
Orange County. Well, make me a little bit jealous. Tell me how the weather is today.
You sure you want to hear that?
Yeah, I told you to make me jealous. Give
All
me
right,
something
all
to
right.
look
Well,
forward to.
we
Yeah.
might have a cloud or two in the sky today. It's sunny, about 90
Oh,
degrees. I cannot
that's
complain.
terrible. Oh man. It is 60. I'm in Idaho Falls. It's 60 right now. I just sent the kids out with sweatshirts and though I think in Southern California when the weather gets down to like 85, people start wearing sweatshirts. But
Something like that. That's right. Yeah, we may get into the 60s overnight.
yeah.
Maybe.
Yeah, and we're high 30s, low 40s overnight right now. So anyway, it's this thing called winter that we get not in Southern California. But anyway, excited to have you on the show. I didn't bring you on the show to talk about weather, so do us a favor, tell us a little bit about yourself.
Sure. I guess I'll give you a little bit more of a background on that. So before I even got into commercial real estate, I was actually in management consulting. So my background's in finance and management consulting, really with an emphasis in commercial real estate, which is where
Okay.
I got my introduction into it. And that led me into the world of private equity, which eventually landed me here in commercial real estate, and more specifically multifamily.
Nice, nice, nice. So what was kind of the driving factor to get you out of one field? I mean, you were in a related field.
Right. You know, maybe even step back a bit further. It's sort of unconventional. So before I even got into consulting, I went to medical school, and the aim or the goal was really to help people. And so while medical fields obviously
Yeah.
impactful, right, in that ability to help folks, I just realized it wasn't for me, and that there are other ways to help folks. And so looking at real estate, that's something that I've always had some type of interest in.
Yep.
And even when I got into consulting, at some point, you're able to start managing where you want to focus, right? Where you
Yeah.
want, what kind of clients you want. And for me, it was just a natural knack towards real estate.
Mhm.
And really, I'm looking at that from this ability where you can contribute to what I'm just going to call holistic well-being, right?
Yeah.
You can provide quality housing, which is great for folks. You're offering them a place that's safe, comfortable, hopefully affordable, contributing to somebody's overall wealth,
Mhm.
happiness, from a community standpoint.
Mhm.
Another facet of it is really just financial stability. And so, which then allows you to fund some of the initiatives that align to what you want to do. And so, like my family and I, we enjoy volunteering, we enjoy donating,
Yeah.
we just enjoy being part of the community. And so, it affords us to be able to participate in ways that we may or may not have been able to do otherwise. Of course, there's other things you can do with it too, right? When
Mhm.
you're owning these assets, one of the things we've enjoyed doing is just implementing green initiatives.
Mhm.
We ourselves, kind of abide by that personal level, right? And then more than anything, above all of that, for us, it's really just been a drive or a goal of mine, just creating this lasting legacy,
Mhm.
not just for myself, but then for our
Yeah.
kids and generally for the community as a whole. So that would be my burning why.
Yeah.
Uh,
Love it.
right. And I think it's interesting hearing other people's burning whys, because sometimes
Yeah.
there's a good overlap, which then
Mhm.
creates interesting conversations.
Yeah. And something you mentioned is something I go back to a lot is there are a lot of synergies in multifamily. We are affecting people at the base level, shelter. We are providing shelter. And if we can make sure that people have a good, safe place to live, obviously, I can't touch the hundreds of millions of housing units, in the US, but
Mhm.
the 1,000 or so that I can control, I can make them good, safe places for people.
Yes.
You can impact the community and you can have those effects. And like you said, the green energy, you can impact that area as well. There's so many areas. I feel, I mean, I don't know any other industry that's going to have so many synergies like that, but
Mhm.
so many ways that you can have impacts on other people's lives and your own at so many different levels. So glad you brought that up.
Yeah.
Yeah. So let's see, you're based out of Southern California. What metros do you guys invest in?
Our focus is generally Texas and Florida. Within there, Central Florida is a big area concentration for us. Within Texas, we've got a small slice out in Austin, and more recently, we've been looking out in Houston.
Yeah. Yeah. And why those metros?
Yeah, well, a lot of that just has to do with resource availability and capabilities. Most of our team is in Florida. It's an area
Okay.
that we've been invested in for better part of the decade at this point. Texas, we've got a partner out there, and then Houston, we've got some key folks of our team that reside out there. And in addition to that, those are just areas we know really well. We've
Yeah.
spent an enormous amount of time just studying the analytics, the markets. So there's
Yeah.
a lot of comfort that I think would expand for multi years before identifying those as areas we wanted to enter into.
Yeah. Now there are some, I guess, recent maybe downsides we'll call them, but I think insurance costs notoriously have gone up in both states. Houston or Texas and I think Houston especially, and then like along the coastal regions of Florida especially.
Sure.
How has that impacted how you guys operate, and what are you seeing in the forecast?
Sure. Great questions. Definitely a big area of discussion. Definitely something we're looking at doing a webcast on actually next month, specific
Mhm.
to insurance. But yeah, it's impacted broadly speaking the industry, as a whole. We've seen it skyrocket. I'm looking at deals, depending on where on the coast. Sometimes it's just eye popping, three, four
Yeah.
thousand dollars a door.
Oh
Um,
yeah.
on if we were to transact on it, renewals have popped. 70% increases are not a surprise
Mhm.
at all. It's really just managing around it because
Mhm.
most of us did not anticipate the significant increase, in insurance the way we've seen it. While we did anticipate insurance to continue to increase, I think some of these renewals that have come out, just looking at some of the numbers, if we were to transact on a deal, are significantly different. So it's certainly contributed to the price
Yep.
dislocation that we're seeing in the market, right,
Yeah.
between buyers and sellers.
Oh yeah.
And so transactional activity certainly has had an impact related to insurance. We're looking at it from kind of an angle of let's just be patient and continue to be patient. Just because we can't pencil out deals, big
Mhm.
part of that is insurance. There's
Yeah.
other headwinds as well, such as the current interest rate environment. We've got other headwinds, related to the softening of the rental market. So,
Mhm.
so there's a number of things contributing to it,
Mhm.
but that doesn't mean we can't continue to work, right? The overall fundamentals of
Yeah.
multifamily are still very strong, especially in the areas we're located in. We've been able to, at least work around it, right? And so, kind of the focus has been on the downside risk mitigation. What kind of exposures could you have? Like, how do we increase our revenue? Possibly, look for areas to lower expenses, to somewhat offset, the
Yeah.
insurance. And you just kind of play around with, depending on the asset you have, the financials and the operations to work with it. In some cases it's opportunistic. Hate to say it that way. All right. But you've got folks who are maybe in a difficult spot, right? That
Mhm.
may have to take in additional capital, or looking at maybe, selling their asset prematurely. And so it offers you the opportunity to work with, maybe that group or those groups where can you get in onto assets that may not have, been out on the market. And so you've got
Mhm.
access to some of that. You could diversify your portfolio further. But again, we're just being very patient, very selective with where we want to, place funds, at least, this past year, and certainly this upcoming, 2024.
Yeah, you mentioned the opportunistic asset, and I think that's a definite part of it. We're working on a property right now where the property is not distressed, but the seller has another property that is.
Mm.
and when they're looking for cash, I think you're going to see that. I think a lot of people are seeing this. It may not be advertised by brokers or whatnot, but
Sure.
since there are a fair amount of distressed properties or ticking time bombs, so to speak, where you have a rate cap that's coming due, and you're going to have to put a seven-figure number in to either buy a new rate cap or refinance.
Correct. Yep.
A lot of people are trying to liquidate and come up with this money.
Yeah.
And if you have multiple properties, I think you're seeing that a lot too, where people are putting other properties up for sale where they can liquidate the asset and then bolster, the rest of their
Into other
portfolio.
ones.
So
Right.
you might find really solid assets, and I think it's from a different perspective, that might be a smart thing to do is, sell your best performing asset because you're going to get the highest price. But who knows?
Yeah.
I mean, anyway, lots of opportunities out there. So, well, speaking of opportunities, let's go into detail about one of the deals you guys have. Tell us, how you pick the property, where it is, but pick whichever one you want to talk about. First, your favorite,
I don't
any
really
one.
have a favorite. I mean, I per se, but there's one I enjoy visiting. It's out in Orlando. Probably don't want to mention the name, just 506B. But it's in Orlando. It's a deal we picked up mid COVID 2020 or early 2021. It was brought to us off market through a broker. And it's interesting because that's kind of created a budding relationship or so. The seller has since, brought a couple deals to us, just to us only. And part of it's just they enjoyed the process, right? When we transacted the first time around. And, so I always view each transaction as an opportunity to really create, I think, another opportunity to get some additional deal flow. Because buyers and sellers, it's not going to be unique to maybe do a one transaction, especially here in concentrated areas. You tend to have deals where you're buying and selling from one another, or maybe not, but at least looking at it. But regardless, it's in a fun part of Orlando. Going back to why I enjoy visiting it, we did have a floating on that one. Given the time period we bought in, which was fairly common,
Yep.
we had a pretty low rate cap on it, and so we were able to, very fortunate to refi that into an agency loan early on, and unfortunately did not have to have one of those cash in type situations. And so we're running it, managing it. It's cash flowing pretty nicely for our investor base. I think some of the things that it goes back to, being patient, identifying deals that you've looked at from a risk mitigation standpoint. Are we comfortable owning this, and really focusing on the downside? Sure, we all focus on the upside. We like the returns, we like the high IRR, but I think, really focusing on what's my risk scenario here? What's some of the worst case scenarios, while realizing, look, rent's not going to continue to increase at the clip that it had been, kind of at the tail end of that pandemic. And granted, we bought this on a little bit of the earlier end. Our risk profile on that was we didn't anticipate rents to go up the same way that they eventually ended up. So none of that was really underwritten into our deal. And likewise, I think the seller had not anticipated anything and probably brought that to market given what that market condition was like at that time. And so, we ended up picking up to what we believe is a nice discount. And so as we've seen, the pricing erode a little bit, for us, it's really just that buffer has eroded. And, and the other thought to it is, we don't focus as much on the cap rates. Like, while we do on cash flowing assets, it becomes like, are we able to, or have we cashed out a good portion of maybe the initial principal? What is the plan on this? Are we putting in a 10-year HUD? Well, we're not going to project what cap rates look like beyond 10 years. And so it really depends on the investment thesis. Some of the shorter term holds that'll have a more major impact on it. But yeah, it's been fun. It's been pretty easy to manage. We've completed a renovation cycle. So we've got a number of deals like that. The one out in Austin's another one. We bought, middle of COVID, nearly doubled the actual value, not even getting into the investment dollars, but just the value itself. And that's been fun, largely because it had a lot of warts on it. And so, for us, that was exciting because we looked at it as, opportunities that we can go in and address, and some of the challenging aspects of it. I think from, an LP's lens, they're just looking at it, how quickly is this asset going to get to, a form where it's stabilized, and do we believe in the sponsor group? Can that team get to what they're projecting? And so slightly different lens that, different folks would be looking through.
Yeah. Yeah. A couple of things you mentioned there that I haven't heard many people say. And one of them I was very happy to hear you say when you talk about putting the long-term HUD on and not guessing what or not projecting cap rates past 10 years, because, that was something that personally we're underwriting all of our deals. We're advertising a 10 plus year hold. And people
Right.
always ask us, what do you anticipating your exit cap? I'm like,
Oh.
that's my answer exactly. Is I'm not going to guess at what exit cap rates are going to be 20 years from now. But
Yeah.
anyway, I was glad to hear you say that. At least one other person in the world thinks like me. So, but awesome.
Yeah. Now, if I could tell you what that looked like, I might not even be on the show. I'd be out somewhere in the Caribbean.
Yeah. I wouldn't need to run a podcast. It'd just be
right.
yeah. So if I knew what cap rates were like 2 years ago, I'd either be, buying a ton or selling a ton right now. I don't know, but
the
we'll
running
see.
joke I tell folks is, I think like 2012, 2011, even the deals we scrutinized, kind of hindsight, probably didn't have to scrutinize anything. I wrote about everything that we saw, $10,000-$15,000 a door. I mean, now you're adding a zero, multiplying it times 2 or, depending on where you're at. And so, it's interesting, but you can't look at it that way.
I have a friend that he's a hedge fund manager, he keeps his finger on the pulse, and he's been a hedge fund manager for a good 20 years. He's about the same age as I am, so I'm mid 40s, but right before the crash, he had a bunch of single family and he was reading his tea leaves and he sold all of his single family portfolio, and he got into multifamily after the crash. And I think he timed everything perfectly, which is absolutely amazing. But I heard him on stage at a conference say, if I could go back to 2007, when the real estate market was at its peak, he's like, I would still buy everything. He's like, knowing what I know now, I would still buy everything I could get my hands on in 2007.
Yes.
And I think that's indicative of it could be indicative of where we are in the market right now. I think the market may have peaked a year and a half ago. I think we're still sliding, but I think 10 years from now, we're all going to look at, 2023 like we are currently looking at 2011, 2012.
I'd love to be able to say that when we get there, but when you're here, it's scary.
Feels different.
It's like, feels very different. But no, I agree with that assessment. I think a lot of good cost bases are achieved when there's chaos in the market. I don't want to say money's made in that. I mean, that's an outcome, but I think in terms of your cost basis, you can achieve a pretty healthy cost basis, which will give you other opportunities and optionalities, on that deal itself, as you're holding it through that life cycle, whether you're looking at refinancing it or layering it or whatever, maybe during a downturn, or you're just waiting for the next market cycle. But, the way I look at it is, you focus on your downside, what's your risk on that? What's your exposure on that deal you're looking at? IRR, could be 15%, for example, on 4 different deals, but your pro forma could look identical on all 4 of those deals. So kind of IRR is the same on all 4, your pro forma is the same on 4, but the risk profile, which you're not seeing the numerical value as an LP, is different for all 4 of those. And so that's where, we focus a lot on that risk profile and understanding, what's the probability or the best probability to kind of achieve what we're looking at doing, and taking that conservative approach. And so, at the same time, like maybe a snapshot in that moment, you're kind of like edging left, which is, on the downside, but almost like a plane going through turbulence, you're going to snap right back to, where that original flight plan was. And that's kind of the goal, is because these are long-term holds. These are not short-term, like, 1 month, you maybe collections is down 2% and the sky's falling, it's down 2%, and then you're going to recover.
Yeah. And I mean, realistically, everybody projects rent increases, year over year. And if you're doing a 10-year hold or something like that, you're right. On a short-term hold, if you're projecting 4% rent growth and you get 2, you're going to feel like the sky's falling. But, if you're looking at a 10-year and you're projecting 4%, you might have 2% in 1 year, and then maybe 2 years in a row, you're below your targets. But the way the economy works is you're probably going to have a couple of years where you're sitting well above those numbers as well. So I mean, nobody forecasted double-digit rent growth for the last 3 years, and that's pretty much what we had. So
Right.
it is very cyclical, and the longer term that you're looking at, the more likely you are to hit the numbers. So have you found that difficult to sell to investors as far as, I know you're doing a lot for downside mitigation,
Yeah.
but I mean, a lot of investors, I think, are trained to just look at IRR and compare the IRRs. I mean, if you're offering a slightly lower IRR with a higher probability of hitting it, have you had
Right.
a hard time getting investors on board with that?
There's going to be investors that, and I can't speak directly to it. I'm not as active in our fundraising process, right? We've got
Okay.
folks that do that on the team. But the biggest thing I've heard is feedback when we're looking at some of these longer term holds. And this is probably pre today, meaning kind of going back a couple of years. We were looking at some deals that had that 10-year plus, and there's a lot of investors that don't want to be invested in anything
True.
that's 10-year hold, and it didn't have anything to do with the IRR or anything. It's just I don't want that
Timelines. Yeah.
right. And then we've got some folks who love that stuff. They want to find those types of opportunities, and as I've had conversations with different investors, investors of our own that are actively invested in deals, and then just other folks in general, because I myself am an investor. And some of these folks are thinking, we want to find more deals like this, or if you're ever selling a deal of your own and you're thinking getting into something that's long term, give me a call. Let's look at that. I think it just varies based on the investor. There's some folks that like to be able to flip it into something, the next opportunity. So it really just depends on your investment thesis, your investment strategy. I don't think there's any right or wrong. I think it's just more of a personal choice based on where you're at. But either one, you're going to have challenges. I think some folks
True.
want the short, some want the long.
I had kind of a light bulb moment coming up soon. We've had a lot of, like most people in the industry, we had a lot of like 3-year holds that we've been advertising, and I've done a lot of, C class or maybe like a B- value add type properties that we've held for 2 to 3 years and sold, right? But
That made sense when
I just switched to a longer term hold period.
Yeah.
And what's interesting is, well, caveat, we do 506Bs for everything. So we're bringing in both accredited and non-accredited investors.
Yep.
One thing I found interesting is when we would do our short-term value adds,
Yeah.
it would be about 60-40 between non-accredited and accredited investors.
Oh,
We'd
interesting. Okay.
Or non-accredited investors in. When we do the longer term holds, we're at 80-20, but it's switched. Most of the non-accredited investors are saying, I don't want it. And most of the people who are investing are accredited, and so it's been interesting just kind of looking at the numbers where we go from majority of non-accredited investors coming into our deals. We switched the timeline. Now, instead of doing a 3-year flip, we're doing a 10-year. And now all of a sudden we've got, kind of a super majority of accredited investors that are coming into the deals. So yeah, it's kind of interesting just to see that.
That is interesting. Doesn't surprise me though, but it is interesting to see that.
I mean,
think,
it surprised me at first, but when I
Right.
started thinking about it,
Yes,
it didn't,
that I agree. Yeah.
Yeah. So I was surprised at first, it's just like, wait a sec. Anyway, we were anticipating, we were doing a large enough raise with a 506B that we were anticipating hitting our 35 investor cap. And, after raising the money, we looked at the numbers. It's like, we only had 12 non-accredited investors. This is weird, but yeah. But end of the day, like I just said, it surprised me at first.
Sure.
When I sat down and thought about what does the average non-accredited investor want in an investment,
Right.
It made more sense. But anyway.
No, it absolutely does. And then probably if you looked at the profile, right, the age group and where they're at, then it probably even made more sense. But I think it's fascinating when you start to look at numbers in terms of like where you're acquiring in or buying, and then who you're targeting, and then the hold period. It's very much like the same thing we look at when we're doing public traded investments, stocks and bonds. What's your duration? What's your age group? What's your risk tolerance, like that profile, which is really important. And it's exactly what we're seeing, in those conversations with the longer term HUD versus, well, I shouldn't say HUD necessarily, but just like the 10+ year hold.
Yeah.
That's what you kind of lean.
I mean, the HUDs normally come with they longer term loans, but and to your point, what's the average profile? the average investor is kind of like me. They've got a little bit of gray in their hair, a little bit of gray in their beard, and so yeah, I would say we're definitely getting a slightly older crowd that's investing as well. So not getting a lot of 20 somethings, not getting a lot of 30 somethings. We're getting a lot of 40 somethings and a lot of 50 somethings. And then when we get the 60 somethings, they're like 10 to 20-year hold. What happens if I die during? I mean,
Yeah,
that's the question we're getting on
sure,
that end.
naturally, right.
Yeah. So, but anyway, well, cool. Let's shift gears slightly and tell us what's coming up next for you.
Yeah. I mean, well, we're redoing our site,
Mhm.
revamping it. I think I don't know if I mentioned it earlier, but we're doing a bunch of webcasts, really just trying to
Mhm.
get more information out there in terms of just educating, not even really focused on JT, not focusing on ourselves. And I think a lot of that just started from having conversations with folks who aren't in the industry, but are just generally curious. I had
Mhm.
a lengthy conversation, turned into like 4 or 5 different conversations with a few different folks that
Mhm.
come from the same group on insurance
Mhm.
and what we're seeing on insurance. And I'm not an insurance broker, but we just get a lot of feedback from when we're looking at deals or our own deals and trying to figure out different ways of trying to get the same type of insurance or similar in terms of coverage, right, without having that massive premium hike. And then just in general, right, how are interest rates influencing or impacting us in the market, like the commercial real estate
Mhm.
market. And just keep in mind, there's folks that are just well educated, but just in different, I would say, professions, and so they
Yeah.
don't always have the time to educate themselves on this or learn
Mhm.
other than just reading the news. And so there's just been a lot of genuine
Mhm.
interest and curiosity, and we thought this would be a great opportunity to get
Yeah.
some folks who are experts in their, I would say, along their part of the value chain in commercial
Mhm.
real estate, and just getting them a chance to just share this info
Yeah.
to folks that are interested. So yeah, that's kind of been there. We've been looking into not necessarily straight acquisitions, like as I was referring to. We're having a lot of challenges getting, I'd say, pricing, really to pencil out. Not to say we're not looking at deals. We're still always looking for deals.
Mhm.
We've got adequate deal flow. We've been
Yeah.
seeing a lot more off market stuff coming to us, not from the brokers, but from folks who are trying to, like, as you alluded to earlier, either unload a deal or two, or try to figure out ways to solve for certain situations where the asset itself isn't a distressed,
Yeah.
uh, right, but is really subjected to a maturing rate cap or a loan, and so like their numbers may or may not make sense. So I've noticed that being a little more interesting. We've been looking at placing capital in stuff like that. That's
Mhm.
really been the near term focus. We've seen some strong operators, good teams that we can get comfortable behind, and placing some dollars there. And then, other than that, it's really been patience.
Yeah.
We're focused on our own portfolio for the most part, and just patiently waiting to find, the deal that makes sense within our investment thesis.
Love it. Love it. Awesome. So winding down,
Mhm.
question that, kind of the give back question to people behind you. If you could go back to when you were
Mhm.
just starting out in multifamily, what
Okay.
advice would you give to yourself?
That's a great question. I think it's probably things that would come to no surprise when you hear it, but just want to hear it again, right? And
Mhm.
I think the number one thing is market research. You got to
Okay.
understand the market dynamics. That's not just what's going on, but understand the supply, the demand, understand the rent growth, just understand what's going on, understand, are people moving in? So what are what's the migration patterns? I think it's just like the overall market research,
Yeah.
and just know your market.
True.
The other one I think is just as important is networking,
Mhm.
right? Build relationships with brokers, with lenders, build them with other investors, talk to people that are going to be they're not really your competitors or your peers, and see, just understand what's going on in the landscape, but also build your team and your network. It's not something that you can just wake up one day and say, I need a loan. I'm gonna go talk to a lender. Like, sure, you can, but
Yeah.
spend time networking.
Mhm.
Just get it out there, right? Which is kind of lead into what I'm thinking in terms of educating, right? Continue to
Yeah.
educate yourself. Like when I first got in, podcasts weren't really a thing. It was just books, right? And the best way to learn was really just get out there and do. And I've got a little bit more of a unique approach because I come from a professional setting that I was exposed to it. I was learning, right, and I was already
Yeah.
in that world. But if I didn't have that, I would just say there's a lot of information out there. But the best way is just kind of get in there. I mean, I think if you can find a mentor that's
Mhm.
been there, done that, that might be the best way, because then you can get access to information. You can underwrite deals and hopefully work with your mentor where there is really no risk, but you're just learning. And then that kind of goes to what I'd say is risk assessment too, right?
Yeah.
Is when you get into this, you've done the first three, right? But we focus on that downside risk. I really think it's important to understand how to assess risk, right?
Yeah.
Whether it's due diligence you're doing on the asset, just the risk in terms of the investment, like how you're structuring it, and then being able to communicate that with LPs, which I think early on are probably going to be your friends and family. So I'd say
True.
maybe those four, and then
Mhm.
you can expand further off of that. But that's
Yeah.
what I would tell my younger self.
Yeah, solid tips. And I mean, a lot of as you were talking, I heard a lot of the things that you made recommendations on come out earlier, in the podcast, the market selection, you talked about why you selected a market, and a lot of the themes you highlighted back there were back in what you said, get to know your market, get to know partner. You obviously didn't get here without your partners, and you've got a couple of really good ones. And I guess right now I should throw a shout out to Deepa because she's the one that introduced us. She's been a
Sure.
friend of
Yeah.
mine for a while, and she's now with your team. So anyway, you got a great find in her. So hope you guys really enjoy working with her. Anyway, last question before we wrap up, and that is, how can listeners learn more about you?
Sure. I would say just go to jtcapitalgroup.com. We are updating the site, but
Mhm.
it's the best way of reaching me or anyone on the team. I know we're active on social media,
Mhm.
largely on Twitter. I don't know all the Twitter handles, but I'd say go
Mhm.
to jtcapitalgroup.com
Didn't
and
they just change the
certainly get
name
a
of
hold of one of
Twitter?
us.
Twitter is now X, isn't it? Didn't they just
That's
change the
right.
name
It
of
is
it?
now X, and I
Yeah.
consider myself more of a lurker than I'm not sure what they call themselves, the ones that actively tweet, or if it's actively X. But
Yeah.
there's a lot of good information on there from folks on there. But like anything, right? Yeah, when you read it, you have to take it and maybe just spend a little bit of time of just understanding the
Yeah.
why behind it.
Yeah. Twitter is also one that I have not been active on. I've been very active on LinkedIn.
Yeah, LinkedIn's another good one.
But man, I'm curious, how Twitter's changing just with the new ownership and what it's gone through
Yeah.
recently. But maybe I'll dive into that. But anyway, that's the product of a different podcast, though. But and speaking of your website,
Yes.
I was reviewing the website,
Mm,
partially as we're talking. It looks really good right now.
appreciate it.
So if you're
I don't think
redesigning
we
it and
touched
making
it in
it
a few
better.
years though, so it's pretty dated with
Oh
people
yeah.
on
Well, I
there.
wasn't reading what's on there, but
Oh, got it, got it.
I
Okay.
mean, it's an attractive website. Let's put it that way. So
Gotcha.
whether the information on there is solid or not, who knows? But yeah. So anyway, if you're listening to this and you want to see what we're talking about, you want to see the new website or the old website, go over to jtcapitalgroup.com, check it out. And like I said, I like it. I got it right in front of me right now. I think it looks good. So if you want the Brian Briscoe opinion, you nailed the look. So don't change too much.
Cool. Appreciate it.
So
Love it.
cool. Awesome. And hey, thanks for coming on the podcast today. Very much appreciate your time.
Hey, thanks for having me. This is fun. Definitely looking forward to chatting some more.
Awesome.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.